Hope everyone is doing well. This is going to be a video over May the 7th, May the 11th, 2022. So the market's at pretty important resistance. Let me draw a line here. So this is a gap from May the 17th. And let me do it like this. As you can see on the monthly chart, there's a small gap. The market finally closed below it on the daily today. And currently the market is down. The all-time high is pretty much 47.80. And so the market's down about 17.5%. So overall, tight enough channel down. First low is probably going to fail. The bears ultimately want to measure move down, which could project around 3,600. And it's possible we get there. Probably won't, but you have to look back and just zoom far enough out. For example, if we go back to 2020, this happened pretty quick. And it's possible that could happen. More likely, though, it'll be something disappointing for the bears, and if we look at a weekly chart, we'll start to go sideways and turn up. But this is enough damage that we're probably going to enter a trading range for years. Just look over here. This is a weekly chart. We went sideways for a very long time. The odds are we're going to go sideways for a very long time here. Maybe 10 years. And maybe do something in the middle. 5-minute chart. So we've been, again, selling off. This is probably going to be a final flag. And the market will bounce back up, testing into this range. 400, 4,000, it's a magnet. So even though we're 60 points below it, we're still probably going to get back to it. So here's the open, and I'll just kind of do like this to make it a little easier. So on the first bar of the day, it's a big bar, big risk. If you're selling, there's a big tail below. If you sell, stop up here. 1 times your risk. A measured move down is basically the low of the range. That's not a good short below. It's big risk and not great probability. So you're selling at the bottom of a trading range, and you should look to buy. If you're selling down here, you're not going to use a stop up here because the risk reward's bad. You're going to tighten your stop, which is why traders, when the market starts to go sideways, they exit and you get a deep pullback. So here, bulls are going to buy. They're going to buy this close. They'll buy more lower. Now, the traders doing that, though, can use very wide stops, and they can scale in, and they can trade really, really small. So that's not practical for most people trading the micros, which is why most people should wait. And then you see a doji, and you can see that bears sold, scalped out, so bears are disappointed. So if you sold here, and you're hoping it's a trend from the open, you want immediate follow through. You want to see this right here. You don't want to see hesitation. It's kind of similar to you're short, the market's selling off, you get this, you're disappointed, and then you get this. This is a second entry buy. So it went down, up, it's a high 2 buy at the moving average, testing this gap. It's possible it's trend from the open up, so a lot of traders get out. Same thing here. There's too much risk that this is a wedge bottom, 1, 2, 3, double bottom here, and that the market races to the upside or rallies to the upside. So a lot of traders would get out around break even, and you can see that happen. Maybe some traders sold the close, and if this is, let's say they sold it, what's this close? This close is at 75.75. The low of this bar was 76. No, that can't be right. The close was 75.75. The low of this bar was 86. So it went down almost 10 points, didn't quite get there, so maybe traders lower their targets 5 points. So if they sold the close here, 75.75, maybe they try to get out and that went to 70 even. So they could have made a profit getting out for 5 points. So you can see bears extremely disappointed. Strong enough bull bar that we're probably going up, but again, big bar, big risk. Traders buying can make quick decisions. And then we get another big bull bar. Well, this means we're going up for a measured move, right? Well, maybe not, because if you're buying, stops down here. So you have the same problem up here. The bulls buying here are betting on a second leg, and they're going to be quick to get out. They're not using a stop down here. That is not where you get out. You get out at the top. You do not buy high in a trading range and then sell low in a trading range. The trader's buying here. If they're going to use a stop all the way down here, they're not selling here. They're buying more down here. And that's hard for people to imagine. That's a lot of risk. That's why most traders are better off getting out somewhere down here. So it's starting to go sideways. Bulls, they're buying for scalps, betting on a second leg up. Big bear bar, it's a 50% pullback from this low to this high. So if you think about it, the bulls buying here, stop down here. What's the probability price goes? One, if they have to risk all the way down here. In other words, the probability at this point is you can get 1 times your risk. So if you have to risk 6 points, 10 points, you'll probably make 6 or 10 points before you get stopped out. And that's why traders got out there. So to explain that better, here's the low, here's the high, and you can see traders bought exactly a 50% pullback, confident that they could get 1 times the risk, and got out of here. And I'm just going to kind of zoom forward a little bit. So rally, deep pullback, disappointed bulls up here, scalping out, bears are selling new highs, willing to sell higher and making money, selling a new high and making money. Wedge top, 1, 2, 3, you call it a double top here, lower high here. Strong enough bear breakout follow through, may get a second leg down, but it's also a possible double bottom, and the bulls want a measured move up. The bears want a lower high major trend reversal. So here, bears have a double top, but strong enough rally, you'll probably get a second leg. So don't bet that this breakout's going to fail. Wait for a resumption attempt, then look for a failure. You have the failure here, but too many bear bars up, make it a second leg up, then you get a bear bar. So it's possible 3 pushes up, 1, 2, 3. You have a higher high here. So it's a major trend reversal. And led to a double bottom. Now the bulls have a double bottom attempt here. 3 pushes down, 1, 2, 3, double bottom. Bulls will buy, stop down here, hoping for trend resumption. Now the bears are hoping for a lower high major trend reversal, but a lot of bars up, but it looks like a leg in a trading range. Weak signal bar. Not a great sell, but it's a strong enough and credible sell that some bulls will get out because it's high in the range. And there you go. So this is probably one of the most frustrating things about markets is these situations. It's hard for traders to imagine, here, odds are you'll get a second leg up. But what about here? That's a lot of bull bars. Why didn't you get a second leg up here? And when the market's in a trading range, traders do not want to have bad risk reward. In other words, here, traders, I think the reality is most traders, let me back up here. Traders that are buying right here, the reality is they're willing to buy lower and they're very quick to get out. And that increases their math. And the problem most people have is they sell too low and can't get out and it reverses up. They buy too high and don't know when to get out and reverses down. So when your risk is big, you have to have high probability. There's a high probability of a second leg. That diminishes somewhere in here. Now you're probably in a channel, maybe in a trading range, and the probability is a lot lower that you're going to get a measured move. So if I'm long here, my stop's down here, what's the probability? I need to know the probability of 1 times my risk, probability of price going all the way up here before it goes down here. That is not a 60% trade, therefore the math's bad. I've got to be quick to get out. So here, same situation. What's the probability price goes down to here before it goes to my target? So if I'm long and I'm willing to stay long below this bar, that means I'm willing to buy below this bar and my stop's down here. The probability of price going up to here before it goes down to here is probably less than 50-50 for the bulls. The bears may have a slight advantage. So the better math on the trade is to sell, stop up here, because I can go for twice my risk. So if I sell here, and you can see traders did that on the close, that's 1 times my risk. But if you notice, the actual risk was even smaller. So traders will sell, and it goes straight down. They take partial profits, betting on trading range price action, and it goes a little bit lower. Second leg down, it's a wedge, 1, 2, 3, bad signal bar. Now the bulls, it's the exact opposite. What's the probability? Price goes all the way up to here before it goes down to here. Well, it's forcing you to buy in the middle, so it's not great, but buying here at a double bottom is probably a better buy than selling to hide this bar stop up here. Reason being is if I'm short, stop up here, this is 1 times my risk, probably won't happen. If I'm long, stop down here, and I hold for a swing, maybe I do get twice my risk. That seems a lot more probable. And there's my actual risk. Market's going up, and look, my actual risk was here. So if I entered here, actual risk here, I got 3 or 4 times my actual risk. Now, it's the same situation. Bulls, although this is a variant of 2 legs up. So anyways, that's why a lot of traders just get out below bear bars. And in trading ranges, signal bars aren't as strong. Traders are looking for context more than I wish these weren't. Let me see here. This is helpful sometimes to view things this way. So here's the market. Do you really want to be buying up here, up here, up here? No. Do you want to be selling down here? Probably not. It's trading range. So sometimes it's helpful to look at line charts and just bar charts to get a better feel for context and make sure you're not being too one-sided or jaded by candlesticks. So 3 consecutive bear bars, odds are the first love's going to fail. And what you notice here is if you're short, maybe you take partial profits, you're swinging the balance, you might get out above that bull bar. But again, big risk forcing you to buy in the middle of the range. Some traders will hold above it. Doesn't trigger, big bear bar. Surprise, maybe a second leg down, may test the lows down here. And now you get a bull bar. It's credible to get out above that bar, but what do you notice? Never got filled. And you could argue, but I won't go into that. So the market's selling off 3 consecutive bear bars, always in short. Tried here, but after this many bear bars, probably minor. And the market sold off. And strong enough trend line break, 3 pushes down. Testing the lows here. Market's probably forming a trading range. So I'm going to kind of show an always in perspective. So always in, selling low in a trading range, probably better to buy down here. The first buy is probably to close this bar, stop down here. Got to be quick to make decisions. And if you didn't scalp out at the top, most traders would probably hold below that bar, betting on a second leg up. And some traders would get out maybe below that bar. Other traders definitely get out below here. It's an aggressive short, but it's reasonable risk reward. So some traders will sell, stop up there, and maybe get out above a bull bar or get out above that bar. And is it always in long? Probably never went always in short. This is probably the dominant feature, so may get a measured move up. So it's reasonable to buy here, stop down here. And, if you didn't get out there, maybe you get out there. Otherwise, get out on the close of this bar, pretty much at break even. And that's part of the problem about swing trading is it's never clear when to get out. So you run the risk of buying, getting out below this bar and getting an upside breakout, having to chase the market. It's similar to when you have a reasonable stop entry. This isn't a great example, but it is an example. You get a stop entry buy, failed, final flag, failed breakout below, possible final flag, reasonable buy, 2 legs up, possible low too short. Even though it's a bad stop entry, on some time frame, this is a credible low too short. So it forces bulls to decide should they get out and then possibly miss this move. So same thing there. And if you don't get out early, then you end up getting out, break even. Same thing here. You buy here, you hold through this, and then you don't get out here, you're forced to get out at break even. So it is sell to close, but low in the range. First reversal up is probably going to fail. And possible measuring gap. So bears, they want to measure move down, which they got. And that's pretty much the end of the day. So overall, limit order day, best thing I would say for most people is, for one, if you're going to trade the micros, make sure your account size is tolerable to be able to trade it and be able to trade small. Number 2 is make sure you're not buying too high and selling too low. And pay attention to your math. If your risk reward is, try to get trades that are 2-to-1 risk reward. So if you have a 50% probability, try to take trades where you've got a 50% probability of going for twice your risk. Hope this video helps.